All right, how about we get into some actual tax strategies for you here? That sound good? All right, so the first, I talked about self-employment tax. The first thing is looking at getting the right entity type in place. And you want to look at the possibility of forming a sub-S corporation for your business if you haven't already. And what a sub-S corporation does for you is it helps you save something called self-employment tax. Self-employment tax is it's your portion of Social Security and Medicare as a self-employed individual. And so if you've ever gotten a paycheck and you look at your paycheck, as a W-2 employee, what you get to take home is not your actual full salary, right? So you have an amount, if you look at the detail, you have an amount taken out for income tax, and then Social Security tax, Medicare tax, and usually some other state and local taxes. That Social Security and Medicare combined is a little over 7.5% that they withhold from your paycheck. And then your employer matches that and sends 15.3% into the government in the form of payroll taxes. And that's what funds Social Security, what funds Medicare. But with the Wall Street Journal did a study several years back and analyzed where you break even on Social Security versus the tax you pay in, and it's at a wage of about $50,000. But the Social Security taxes stop at right around $170,000 in tax. So anything above a wage of about 50 grand, you're throwing money away for the return you get. And so when you are a self-employed individual and start operating as a sole proprietorship, there's no one to withhold that 7.5% out of your paycheck and the revenue you're collecting. There's also no one left there to match that other 7.5%. But of course, Uncle Sam still wants their fair share. So you're left holding the bag for the full 15% from the very first dollar of your earnings on top of income tax. And so it can be a real whammy of a surprise for people the first time they start generating some real money in their business, because income tax, you get your standard deduction and then it's a gradual increase in the rate, whereas self-employment tax is from the very first dollar. And so if you form an S corporation, you move all your profits into the S corporation, and the profits of the S corporation are not subject to the self-employment tax. So you pay yourself a reasonable salary, and then you take the rest out as a distribution. So let's say in this case, we're just using the maximum amount, around $170,000. So you pay yourself a wage of $5,000 a month. So instead of paying 15% on the full 168, you pay 15% on 60,000. Now this doesn't mean you take a massive pay cut and only take out that small amount. It means you just pay yourself a couple different ways. One through wage, and then the other through dividends, just like if you got a dividend from a stock that you own. And so by doing just that one thing, you save almost $17,000 in self-employment tax. And this doesn't even impact and lower your borrowing abilities for a loan, because all of the profits flow through to your personal return, and it's what's called a pass-through entity, which means you pay tax on the profits of the business on your personal tax return, whether you pull the money out or not. So that's why there's no extra tax when you pull that money out. Side benefit to being an S corporation is you're about 8 or 9 times less likely to be audited as an S corporation. Sole proprietorships have about 2.3% audit rate. S corps have 0.2 or 0.3%. So you can afford to be a little more aggressive and also sleep a little better at night, knowing there's a very, very small likelihood that you're going to get audited. And that surprises a lot of people, because they think, oh, I'm a big entity now. You think you'd be a bigger target, but it requires a higher level auditor. And so there's not as many of them. And so that's why. What profit amount would you say to switch from a sole proprietor to a sub-S corporation? So there's a few factors that make a difference, and one of them I'm going to talk about with a different strategy. But in general, in California and in most states, period, it's profits, not revenue, but profits of around $60,000 to $70,000. That's when it's a break even, where the extra tax prep fees and kind of hassle of running payroll for yourself offsets and breaks even with the benefits that you get. And if you're doing profits of $60,000, you wouldn't pay yourself a reasonable wage of $60,000. You'd pay yourself maybe a $2,000 a month wage, and then you'd save the 15% of the difference there. You want to consider renting your personal home to your corporation for your board meetings. So this is known as the Augusta Rule, and depending on the value of your home, could maybe get you up to about 25 grand a year tax-free. So I'll explain the rule and then kind of how to take advantage of it. So it's known as the Augusta Rule. It's a rule that says you can rent your home, if you own it, up to 14 calendar days per year tax-free. It's known as the Augusta Rule because everyone who lives in Augusta, Georgia, where the Masters golf tournament is, they all clear out of town when the golf tournament comes into town because they could get a good chunk of change renting their homes out to all the mega wealthy people and celebrities that are coming through the town. So someone went and greased the palms of Congress and said, hey, come on, man, just give it to me tax-free. I'm not in the business of renting. Normally, if it's less than 15 days a year, let's just make it tax-free. So that's where this rule was passed. And how you can take advantage of it as a business owner is start holding a monthly shareholder board meeting at your house and rent out the use of that house out to your business. So if you do that once a month plus a bonus mid-year second day and a bonus year-end second day for annual planning to get to that 14 days per year, then that's 14 days of rent tax-free from your business. It becomes deductible as rent expense to the business and tax-free rental income to you. Everything's a deduction until you get audited. And we want to make sure that you can sleep at night knowing that it's going to hold up if you happen to, in the small chance that you do get audited. And so number one is you got to have an office outside your home because by definition, if you're only working in your home office, then it's going to be used for your business more than 14 days a year. So you got to have an office outside your home. It's also got to be a reasonable amount for meeting rent. So if your home's worth $250,000, you can't go and charge $100 grand a day and take a deduction for that. So reasonable amount, best practice would be to go to your town and find a couple hotels and event centers that are renting out rooms that are similar size to your common area of your home and see what they're charging for a day and take the average of those. If you want to do a quick and dirty kind of back in the napkin, we say 1/10% of the value of your home. So if your home's worth $500,000, $500 per meeting, so knock the 3 zeros off the back, $100 per meeting times 14 meetings per year would be $7,000 tax-free out of your business. And document. So you want to have an agenda of what those meetings are and document what the items that were discussed, decisions that were made, whether that's new marketing budget set, held a tax planning meeting from home over Zoom, decided to hire a new assistant, whatever that might be. Document those items, and then you want to actually move the money. So we're not just writing things off by journal entry. You want to have a paper trail of moving the money, and whether that's through a physical check or just an electronic transfer to yourself. And what I like to do is just schedule your meetings out to be once a month, and then schedule out the checks or the auto transfers. You can set a recurring transfer in your bank from one account to the other, and then you just make sure that you don't forget. Suddenly 5 months go by and you forgot to pay your rent checks. Although you do report it on your Schedule E as a rental, but then you also back it out as an expense as non-taxable income. So net it's probably going to lower if that's a concern. You always want to think about when you're doing any tax planning, when we take deductions, they lower your income and taxable income, but they also potentially lower your borrowing ability. And so we can tax plan you into the poorhouse on paper. That's just a side note. But if we can't, if you bring your income all the way down to zero and you can't even qualify for a massage chair loan at the Sharper Image, then that doesn't help you achieve your financial goals. So we always want to balance the dance of bringing your income low, but then also making sure you have, if you've got borrowing needs coming up in the next year or two. But yes, it does lower your taxable income, your AGI, and becomes tax-free rental income that you can use however you'd like. Next is hire your kids. Anyone got kids? Did I see a 6? Wow. All right, you're going to love this one. The IRS has a rule that says if you pay your under 18 children from a sole proprietorship, they are exempt from payroll taxes. And under the current tax law, a child can earn up to $15,000 in a year and pay 0 federal income tax. Now, depending on the state, there might be a small amount of state income tax, but in general, you get that money effectively tax-free. And so, number one, like I said, pay them from a sole proprietorship to avoid payroll taxes. And You might be saying, Tyler, you just told me to move to an S corporation. Why are you telling me now to go back to a sole prop? Well, what you do is you still run your main business out of an S corporation, and then the S corp pays the sole prop. There's just one extra step, saves you 6 kids if you're paying them $15,000 a year each, $90,000 tax deduction. If you pay them directly from the S corporation, that's going to cost you about $14,000 in payroll tax. One extra transfer eliminates the payroll taxes on that. So that's the critical piece of doing it the right way versus the wrong way. And yes, it is earned income. So you've opened up a Roth IRA for them. You can max out a Roth IRA with tax-free money, and then it grows tax-deferred and is tax-free forever, which is really super cool for setting them up for a great future. But big key here is they've got to actually do something to justify the wage. So for your older kids, they can help with admin work, help sort papers. If you do door-to-door sales, take them door knocking. Maybe they can help manage your TikTok page for as long as that app is around, or your Instagram account, or whatever it might be. For your younger kids, we've had a lot of clients hire their kids as models for their websites, for their social media, helps with your personal brand. People love doing business with the family business, and I can attest to this. Helps increase that know, like, and trust factor when they go to start working with you. But you got to actually, take the pictures, post the pictures, have employment agreements, actually pay them, and again, we're not just writing things off by journal entry, and then file payroll tax reports. So you're issuing them W-2s, you're giving them quarterly payroll tax, you're filing the payroll tax forms for them, and then a regular, at least monthly salary is going to hold up better in an audit. The more they can truly look and feel like an employee, the better it's going to be from an audit and a holding up standpoint. And most employees that I've had in the past like to be paid fairly regularly, not just willy-nilly or once a year, right? So kind of at least monthly is going to hold up better in audit. So you got your business here, and then you transfer the money to the sole proprietorship owned by you or your spouse. And by the way, that doesn't mean you have to have a separate sole prop bank account. When you're a sole proprietor, you are the business, so it can just literally go from your business account to your personal account, and then you open up a bank account in the kids' names and move the money into that. If you're at all interested, we do a free tax review. You meet with our team, and we go through a lot of these questions about stuff like this and see what you might be able to take advantage of. And would love to meet with you if that makes sense.